Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a really interesting stock in the market right now, and that stock is Alibaba. And we can see that over the last year, Alibaba is down 13%, while the rest of the market is up 3%, so they are underperforming the market at the moment. And Alibaba is basically the Chinese equivalent of Amazon, and there's been a lot of news recently coming out surrounding Alibaba. So in this video, I'm going to cover that news. I'm going to look into their financial statements to get a better look at the underlying financial health of the company. And lastly, I'm going to use a discounted cash flow model to figure out the intrinsic value per share for Alibaba so we could know if this is a good price to buy into the stock from a value investing perspective. And so right here, this article is titled Alibaba Stock Bear versus Bull. They basically talk about some of the pros and cons of potentially investing into Alibaba. And if I scroll down here, they start off with the point that the bulls are making. For starters, Alibaba has a 51% market share of retail online sales in China. The lockdowns were a huge headwind for Alibaba. They ended up decelerating their revenue growth, but a reopening in China could potentially be a big boom for the company. Also, Alibaba is currently the leader in China in cloud services and the fourth largest in the world by revenue. And recently they announced that they plan to spin off this cloud services unit into a separate publicly traded company, giving existing shareholders stock in the new entity. And with all the optimism surrounding the cloud businesses, this could unlock a lot of shareholder value. The stock has been beaten down quite a bit, as you can see right here, over the last year or so. And so as a result, their price to earnings ratio as of today is about 19.8. And that's the lowest it's been over the past 5 years. Well, the lowest level over the past 5 years was 16.2. So it's basically right near its lowest level right now. So the valuation is compelling. Add in the fact that Alibaba recently generated $25 billion of free cash flow in 2022 in their fiscal year. So it could be a good opportunity right now. It's underpriced. They're producing good free cash flow. If China's economy reopens, it'll give their business a boom. They have a dominant share of the retail online sales in China, and they also have a growing cloud services segment of their business. But here is the con of potentially investing into Alibaba. These are the points that the bears are making. For starters, management recently announced that they're splitting into 6 different business segments. And so although that could unlock shareholder value, a major restructuring like this adds a tremendous amount of risk. There are a lot of moving parts to consider, especially since Alibaba is trying to do this during a time when markets and economies are under pressure. Obviously, the huge elephant in the room is the regulatory regime in China. The Chinese government started cracking down on the tech industry more than 3 years ago because they were becoming too dominant. In April 2021, Alibaba was fined $2.8 billion for monopolistic behavior. And other tech giants in China like Tencent, JD.com, and ByteDance were also forced to undergo big changes to appease the Chinese Communist government. And so basically this article points out right here, the whole point of stock picking is to hopefully pick the stock that becomes dominant one day. But it's kind of difficult to do that with Chinese stocks, mainly because they're playing in a field where they can be upended by the government without notice, which makes it very difficult for investors. So those are some of the bull and bear cases for Alibaba. There's a lot of risk, but there could potentially be a lot of reward as well. And right here, these are their financial statements comparing this is actually the fiscal year 2023 fourth quarter. So this is the final quarter of their fiscal year for the 3 months ended March 31st, 2023. And we're comparing those results to the 3 months ended March 31st, 2022. And we can see that revenue year over year increased from about 204 billion yuan to 208 billion yuan. So that's equivalent to $30.3 billion. So that's an increase of about 3% or 2% year over year. Then if I scroll down here, we can see their bottom line net income here. In the fourth quarter of 2022, they had a net loss of 16 billion yuan, which came out to $2.5 billion. But in the fourth quarter of 2023, fiscal year 2023, they had net income of 23.5 billion yuan, equivalent to $3.4 billion. So their bottom line basically increased from a net loss of 2.5 billion to net income of 3.4 billion, which is obviously very good news for Alibaba. Then right here for their balance sheet, we can see that total assets are up from 1.6 trillion yuan to 1.7 trillion yuan. In other words, that's $255 billion of total assets. And then if I scroll down here, we can see that they have $162 billion of total equity. And of that, they have an $87 billion retained earnings line item. And then lastly, for page 40, this is their cash flow statement. We can see that it's pretty condensed. They don't go into the specifics. All they show us are the end results here for operating cash flow, investment activities, and financing activities. Operating cash flow increased to $4.5 billion, and it looks like they had cash use of $1.3 billion in financing activities and $3.9 billion in investing activities. But as we saw from the article, they did have pretty good free cash flow. They had $25 billion of free cash flow in their last fiscal year. So that is pretty good news for Alibaba. And so right here, this is a discounted cash flow model to figure out the intrinsic value per share for Alibaba. Yahoo Finance is estimating that the company is going to grow at around 1% for the next 5 years. They had $28 billion of free cash flow. I got this metric from TradingView Stock Screener, so they said 28 billion. The article said 25 billion, so you could use your own metrics if you want to, but in this case I'll use 28 billion. So 28 billion of free cash flow, $330 million of cash on their balance sheet, and 2.5 billion shares outstanding, putting their estimated intrinsic value per share at $115 per share, which means at the current share price they actually are trading below intrinsic value per share at the moment at $86 per share, compared to $115 per share. So right here, I compared them to some other companies they're competing with. These are basically American versions of Alibaba, Amazon, and Walmart. And we can see that across the board, Alibaba has a middling of the pack gross profit margin. They are at least profitable, whereas Amazon is not. And they also have the lowest price to earnings ratio at 20 times earnings at the moment. They don't pay a dividend. Walmart is the only company that pays a dividend. They pay about $1.56 for every $100 that you invest into Walmart, or $2.24 per share. So from this perspective, it looks like Alibaba is pretty competitive. They're about middle of the pack. Not really much to say here. It's obviously a little bit difficult to compare these companies against each other, just because being an American company, you have a much larger advantage in being a Chinese company competing in a landscape where you have a communist government that could potentially shut your business down without any warning. So interesting comparison, but from a financial ratio perspective alone, it looks like Alibaba is basically middle of the pack. And then lastly, to end off the video, I want to compare Alibaba to some of the other companies we've looked at in past videos. Alibaba is trading below intrinsic value per share according to those Yahoo Finance estimates. They're trading at 0.75 times their estimated intrinsic value of $115 per share, because they're currently at $86.75 per share. So far, it's just Alibaba, Google, General Electric, and Etsy that are the only 4 companies we've looked at that are trading below intrinsic value. For growth rate, Alibaba had a 1% growth rate, not good enough to get them onto the growth rate table. Chipotle has the #1 spot with 26%. For gross profit and net profit, Alibaba had gross profit of 36 and net profit of 8. So that's not good enough to get them onto the gross profit or net profit table. Adobe holds the #1 spot with 89%, and Microsoft with the #1 spot at 36.6%. And then for stock performance, we can see that Alibaba is down 57% over the last 5 years. So they're not good enough to get on this table. Tesla has the #1 spot, up 1,000% over the last 5 years. So based on this, it looks like Alibaba isn't really competitive to the other companies we've looked at in any way besides intrinsic value. They're sort of middle of the pack in terms of comparing them to other online retail companies. And then lastly, according to the discounted cash flow model, they are currently trading below intrinsic value per share. So definitely interesting. Obviously, these are Alibaba's ADRs, not their exact shares that are traded on China's stock exchange. Let me know in the comment section down below what you guys think of Alibaba. Are you guys buying any ADRs? Let me know what you guys are doing in the comments down below. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.